how many of us have them? Funds. Ones you can depend on. Get those funds. Welcome to the Balance Your Books podcast. I'm Kimberly.
I'm April.
And I'm Keena.
And we're your balance partners.
Welcome to our podcast.
Hey.
And to start us off, before we do anything, Kimberly, what do we want to remind people of?
So you can find us on YouTube, Apple Podcasts, and Spotify. Balance Your Books Podcast. You can also reach us at yourbalancepartners.com. Please like, subscribe, share with your friends and family. And if you want us to talk about any topic in particular, let us know.
Let us know.
Yeah.
Today's topic. I think, you told me they don't say no cap anymore.
I don't know.
Oh, I don't know either.
Do they?
Yeah, I definitely don't know.
So, this is cap instead of no cap. Because we're talking capital dollars.
Capital.
Capital dollars today.
And not the word dollars in all caps.
What? Oh, got it. She's cerebral, y'all. She's cerebral. Yes, capital dollars. So, Professor Johnson.
Yes.
What is capital? Let's start there.
So what is capital? So I'm trying not to get too technical, but when you're talking about capital, you're talking about major investments, and capital dollars are those dollars you use for those major investments. So it may be buying a building or something like that. And when you're thinking about a capital infusion, that's typically when you might get a loan of a large amount, or you might get equity investors, a large amount of dollars coming into your organization so that you can do certain things. But it's not to run your business.
And capital dollars are not dollars from selling the product.
No.
That's your sales. That's on your profit and loss statement. That is your revenue. That's the money that you make from selling your services or your goods. This money that you receive is not related to that.
No, it is not. It is money that you receive to probably grow your business.
Hope you're growing.
Yeah, it should be to grow your business, to buy a huge item for your business, that sort of thing.
Yes. And so let's talk about at what point in your business do you need capital dollars? So we kind of go through the life cycle of your business. You've started it. Let's say you're a widget company. So you're selling widgets. And
Are people still selling widgets?
Do I need to use a different term?
So audience country.
Widgets was a term that was used back in the 1900s.
Let's use a term people know today.
Oh, what do they know today?
I mean, I don't know. It could be in this day and age marketing. It can be social media.
Okay.
Sometimes you can get a capital infusion for those type of things, unless you're talking about actual fixed assets. That's
so back up.
Maybe the professor can let us know.
So let's back up. So for Keena's example, we went way off. You are a company and you sell a product. Let's do a throwback to a prior podcast.
Okay.
You're selling t-shirts.
Oh, yes. Okay.
T-shirts. But you're good at selling t-shirts.
This time t-shirts is your jam.
Right.
So you sell t-shirts. And you started your business. Maybe they're special design. Maybe they're cut a certain way. Like maybe they're the most perfect women's t-shirt. The way that fits a woman's body.
Yes.
Let's say that's your product.
Or maybe I mean, you could keep that same example, but maybe it's not just the T-shirt. Maybe it's the machinery you need.
Well, that's what I was going to.
Yeah, we're getting
okay,
there. We're
okay,
getting,
okay,
we're,
that's where I was going
we're
to.
distinguishing between operational money and capital
Yes.
money.
Okay, we changed.
Okay.
We
Yeah,
changed
so-
the
yeah,
widgets
yeah,
to T-shirts.
yeah, I changed the
Okay,
widgets
all
or
right, thank
T-shirts.
you.
Yes,
Since
yes.
people wear T-shirts,
But they don't buy
whatever these are, the
widgets.
2020s.
Okay.
I don't know what these are
21st.
called.
We're in the 21st century.
But is it called 2020s?
Whatever. Yeah.
During this time,
Okay.
people still buy T-shirts since widgets don't exist.
Okay.
And so you have your T-shirts. You sell your T-shirts. That's your revenue, right? You sell your T-shirts for $40. That's your revenue. Now the equipment. So you have to print them, or maybe you have printing. Do you have etch? What do they call it? Embroidery, or
Yeah.
whatever kind of equipment you have. That typically is purchased with
Capital dollars.
right? And so a lot of times, where do you get those capital dollars from? Typically, those type of things are expensive, right? So usually a piece of equipment, like a piece of embroidery equipment, that could cost you $5,000, $10,000.
Yes.
And that it could be a lot, which is a lot of money for a small business. So where do you get that money from? What do you do? How do you figure out how are you going to fund the equipment that you need in order to make your T-shirts? You've got a lot of people who like them. You've got a customer base that it wants your T-shirts. You've got the best cut T-shirt ever. Now, what are you going to do? How do you get capital dollars to help you grow?
Well, most people use Discover, MasterCard, or Visa. Sometimes American Express.
Right. True.
A
Now,
lot of
it-
people will put it on their credit card.
Yeah.
Yes.
But
yes.
but honestly, depending on where you are in your business, you want to use your credit card for your daily operational expenses. You would not want to use your credit card for a huge purpose. If you can find capital dollars, you wouldn't want to use your credit card for a huge purpose, because then you're carrying the balance and the interest rate on that credit card is going to be high.
Yes.
So if you're a thriving business with solid financials, you may go
An
down to the
investor.
bank and ask for a
the
loan.
bank.
Or you may go and try and get an investor in your business.
So let's go the banking route.
Okay, let's do the
Let's do the
Okay.
banking route. Because the investor route, there's a lot of relationships, and maybe we'll do another one that's really
Yeah.
dig deeper on the investor side. Let's focus this one on utilizing either a bank or a small business loan servicing
SBA.
organization that does small business administration loans, SBA loans. So let's talk about when you're ready to go to one of those types of entities. So it could be a Chase, Bank of America, Truist kind of thing. Or that next tier is in whatever state you're in. They may also have those kind of programs that are not banks, like commercial banks, but they are organizations that are lenders. There are lenders that lend to small businesses because of the SBA relationship.
You're right.
So let's say you're going to one of those, and let's talk about what you need to do to be prepared in order to be able to get those capital dollars.
Not needed.
Well, let's talk about that.
Because
What does that mean?
When you need the money, that's when they don't give it to you. When you don't need the money is when you can get the financing.
And what
or
is
the
that
loan.
really? So dig it.
So what
do you
that
mean
means
by that?
is excellent revenues, minimizing your expenses, having net income, having a lot of cash on hand, great balance sheet, excellent equity,
Yep.
and
And planning.
yeah,
Because
taking
you're-
yourself off payroll, possibly. So, because a lot of entrepreneurs, when they do pay themselves on payroll, they're the largest part of the payroll, or can be. And so you may have to remove yourself, to make it
Strengthen your
look
balance
better,
sheet.
and just bonus yourself at the end of the year, or pay yourself double the next year. So definitely your financials have to look excellent. They have to look like you don't need money.
And that requires planning, because if you're buying this business, you have buying this equipment, you've planned out. You have the solid balance sheet, and it's for something that you're going to do in the future. So you planned to get this money in the future. And during that planning is when you're building your balance sheet. But what you need to do, you need to call your balance partners and have them come in and make sure that your financials are secure and they look good and they can help you analyze. And we know what the banks or the lenders are looking for. That's what you need to do.
Because to your point, because I know there's some small business owners that are out there who are like, well, I mean, that doesn't make sense to me. Like I need money to grow. I've got this great idea, and you're saying that no one's going to give me any money?
No. They're not.
Yeah. And so let's break down a couple of things that you mentioned. One is having net income. Okay. How much net income should they have before they go to the bank? Because when you're saying net income, you're just saying that my revenue was more than my expenses, which led me to net income, high level.
Yeah.
And so, okay,
2 to 3 years.
Go ahead, say that.
I said 2 to 3 years.
So you need to have about 2 to 3 years
income.
Of positive net income. If you're going to go to a traditional bank.
Yes, because that's what we're talking about, right?
Well, I said also secondary lenders. So if you're going to go to like a Chase, a Bank of America, a Truist, whoever else is in your area, those are typically going to want net income 2 to 3 years consistently. And the way they know that there's a couple of things they're going to be looking at is they're going to ask you for those financials for each one of those years. And the only financials they really look at are what?
Your balance sheet, and really your balance sheet.
But from who? Like, who do they?
They want to make sure that these your tax return.
Your tax return.
Your tax return. So you can't make up something and send it to them.
Exactly.
Right. Your financials need to be probably reviewed, if not audited. I don't know if they're really doing.
Yeah, they don't necessarily have to be audited as long as the net income is reflected in your tax return.
Your tax returns. Okay. Yeah. So you can't be 3 years behind on your taxes.
No.
Yeah.
Trying to go get a loan.
No. Your tax. Yeah. Yeah. Because I've had clients. I went to the bank. Can you believe they didn't give us a loan? We made $10 million last year, and they didn't give us a loan. And then you look, it's like, because you didn't have real financial statements, and this is true. They did not have real financial statements. They, their financial statements, they had nothing that then that the bank could then compare to what was on the tax return to make sure, hey, well, this is the detail of what you actually reported. Yeah. So they could align and see that those two things matched. Yeah. Just the baseline. And it's like, well, of course they didn't give you any money. You look jank.
But that's what I'm saying. When you go to a bank, it's good to have, you're right, audited financial statements aren't needed, but compiled financial statements by a CPA or reviewed financial statements by a CPA.
Yes.
And then you can also hopefully reconcile between your tax return and your financial statements.
Yes.
To give them the correct perspective on how well your business is doing.
Yes. Because a couple things that we have seen is that when we've taken over a client, we have recommended to the client that we needed to restate prior years with not only redoing their financials, but also what they reported to the IRS.
Yes.
Because it wasn't correct. And one of the things that we do as part of that is what we talked about is the balance sheet. And what's the balance sheet, Professor Johnson?
The balance sheet really shows the state of your business at any given day. It's a point in time. It shows how liquid you are, meaning how much cash you have. It shows what your liabilities, who you owe. It really shows the strength of your business on any given day. And a lot of business owners only focus on the income statement because it shows income. It shows I made money and I have a bottom line. And they don't make sure that the balance sheet is correct. But the balance sheet accumulates all that data. When April talked about you need to have net income for 3 years in a row, all that flows up into your retained earnings. Those are the earnings that you have retained in your business.
Retained earnings.
Yeah.
That is something that all of you need to understand and learn what that is. On the balance sheet, in the equity section, it reflects if it's a positive number, that means that what you contributed initially to start your business plus each year you've had net income, that means you have a positive retained earnings. If your retained earnings is negative, that probably means you had some losses in some years that are reflective in that retained earnings.
That would be an accumulated deficit.
Oh,
And it's not retained earnings because you didn't earn anything and you did not retain anything. You have an accumulated deficit.
ooh.
That does not sound good.
Does not. And so when you're looking at it and you look, because a lot of times you just flip past that balance sheet and want to look, did I make money? Did I make profit? Which is important, but you want to look, if you're planning on getting a loan, you got to figure out how much time and what type of profit do we need to get to build our retained earnings back to positive from negative.
Yeah.
Right? How do you get that retained earnings number from negative to positive is through profit every year. Maybe you'll get it all in 1 year. It depends on what it is. So definitely, if you're going to a traditional bank, that is the main thing that they are looking for. It's not necessarily your business ideas, not necessarily you. It's your financials. And with some of the other lenders that you have they do small business administration, SBA loans. They their requirements are a little bit less a lot of times because their whole existence is based on giving small businesses loans. So their risk profile is a little bit less than what a traditional bank's risk profile is around loan. So for them, they may be okay that you've only had, like maybe you could tell more of a story. And that's when your CPA really, really comes into importance, is being able to help you translate that story, because you may have been a loss 1 year, profit the next year. Maybe you're almost toward the end of the year this year and you've been profit all this year. And with that story, they may not give you as much, but they may give you some. So then they start to ask, well, what are you going to use that money for?
Right.
Because that's also a piece of, do you really know what you're doing? Are you going to use it to go to Jamaica? Or is it really like you're going to buy this piece of equipment in our t-shirt example?
Right.
If right now I can only make 10 t-shirts an hour, look at these orders. I need 10,000 t-shirts. If I had this piece of equipment, I could then get these orders. That type of loan, even though those second tier, they're like, oh, okay, no, we see it. We see you show them the equipment, you show them how much it costs. This is what I'm going to use the money for. Then not a lot of times, but you have a better chance of getting that loan, being able to tell the full story of how you're going to use it in your business.
Yes.
And how it's going to specifically grow your business. Because a lot of those lenders, part of their story, they get it. I don't know if it's, they get fees and they get paid money based on servicing loans. That's how they make money. So it doesn't behoove them to keep the money.
Right.
They just got to keep the money. They have to make sure that they're lending the money to the right risk profile.
Yes. Yes.
So when we talked about that, let's talk about then, that's what we call source and use, right? So you got the source, whether the source of the funds you're getting and what are you going to use them for. Talk about the types of things that you should use capital dollars for.
Well, like we talked about buying machines.
Growth.
Yes. And
What kind of growth?
I mean, I guess it depends on the business, because machinery could be growth, you know, being able to add another line that then adds more production. I know I keep kind of going back to marketing, but because that's one of those things that can come out of your general operating budget. But sometimes it takes an infusion of larger dollars
Yes.
to get your marketing to the next level.
Yes.
Yes.
And so that's more of what I'm speaking of.
Yes.
Yeah.
And especially in this social media world,
Yes.
that becomes very important. I mean, when I get on, first of all, I just got on Instagram. And when I got on Instagram, I mean, how many times do I have to see a video about a body shaper? And I need one.
What are they trying
But
to
how
tell
in
you?
the hell do they know I need one? I have seen every body shaper that exists on Instagram. And I just thought, wow, they're really investing in the marketing aspect of their business because they know if they show it to me one more time,
You're gonna
I
click.
might click shop now and buy.
Yes. Yes.
Because
yes.
they just told me that it was buy one get one free, but they didn't know what they were doing. So now you buy two and you get three
Oh yeah.
free.
Oops, we made a mistake. Oops, we made a mistake. Yes.
Yes.
But that
to
stuff
lure you in.
works.
It does work.
You know?
It does.
So
And you have to invest in it. That is a good capital investment.
Yes.
Is marketing. Sometimes people.
Yep.
It depending if you're a services organization and you need a certain type of skill set for that service and it's going to cost you a lot more, but the trajectory of your business can grow if you're able to bring in that type of person with that skill set. That may be something that you include in capital dollars, because it's really focused on the growth
Right.
Yes.
that you're talking about. So definitely like equipment, marketing, sometimes people. Anything else?
It should
Wanna
not
highlight?
Well,
Go ahead. No.
it shouldn't be to sustain your business
Let's talk about that.
because I think if
Well, you're not gonna get an investment if it's to sustain your business because your financials are gonna show that.
right,
Yeah.
but you might get something with the credit card interest rate. You
Yeah.
might
Oh,
get something
yes,
with
yes,
a
yes,
high
yes,
interest
yes,
rate.
yes,
But
yes.
it should not be to sustain your business. It should not be that, oh, I'm looking and we paid too much for this and now we're going to be in the negative. We need to go get a loan
Yep.
again because then you need it.
Yep.
Yes.
And it should not be for that. I'm sorry.
Yep.
You said anything else that
Yep.
your money should go towards.
Yep.
And I always, again, I just think it's growth. Whatever type of growing things that you need. If it's no, it could be for like a remodel. Let's say you have a brick and mortar business and you want to remodel your store, and it's going to take a nice investment. But again, this is something that's going to strengthen your balance sheet. It's going to be an asset that's going to sit in your balance sheet and it's going to strengthen your balance sheet. It should not be for regular operations.
Yeah, and I think at some point in our podcast series, we'll start to break down the financial statements, each part of it,
Yeah.
for you a little bit
Real
more
technical for you.
Yeah, to get a little bit more technical, because the way capital dollars show up in your balance sheet versus your profit and loss statement matters, and how those are accounted for. This is why you want to have a CPA doing your financial statements. It's not bookkeeping.
Right.
Is because how those things are accounted for. There are rules around where things are accounted for, and I've seen things be accounted for in the wrong place, and so therefore may make your profit and loss statement look worse than it should,
For
because some of those
example,
things should be on the balance sheet.
Mortgage payments going straight to the profit and loss statement. You're paying your loan, you're paying your mortgage, and all those payments going straight as an expense. it's making your income lower
Yep.
because this client was not paying attention to the balance sheet. Even
all.
told me, hey, I don't care about the balance sheet. Well, I do. When I was trying to, like, we need to sit down and talk. Oh, I don't care about the balance sheet. I need this statement to send to the bank.
Yep.
It's wrong.
Yep.
And the only way to get it right is to care about the balance sheet.
Yep.
Right.
Because your expenses are much less than what you thought because you're throwing all that money into your profit and loss statement.
And to add on to that is your tax return is not really done if the balance sheet portion of the tax return isn't done.
Preach.
So you have to have that I have seen tax returns filed, and I know April has, tax returns filed that only had the profit and loss portion done and did not have Schedule M and Schedule L or
The
Schedule
balance,
L.
Yeah, the balance sheet.
The balance sheet.
the balance sheet schedules completed.
or the
But
balance
you
sheet
don't
didn't
have
balance.
to have that on every tax return. It depends on how much revenue or assets you have.
Well-
That dictates whether or not you have to complete that Schedule L. So some people can get away with it, although it would be
It
good
wouldn't be
to
good for your
include.
loan.
It would be good to include. Some people can get away with it if their net asset or their total assets aren't more than, I think, 250,000. Don't quote me on that. You know, so if it's less than that, you don't have to do it. If it's more, then yes, you have to include.
Or if
the
you have a
sheet.
balance sheet, make sure it balances.
Somebody-
You're the one that
pause.
pointed it out to me. You're the one that one of our clients, their prior year tax return balance sheet did not balance.
Oh yeah, on the tax return.
Yeah,
I
yes.
was like, wait a minute.
Yeah, on
With
the tax return.
technology,
No, on the
Yeah,
tax
yeah,
return.
everybody should at least be in balance.
Right,
Yeah,
right.
yeah,
But on
yeah.
the
But
tax
yes,
return,
on the tax return, yes.
balance
Everybody's
sheet.
doing. Everybody who's doing taxes probably shouldn't.
right.
Right. Exactly.
You might not want to do it yourself,
Right,
but yes,
right.
we have definitely seen errors on tax returns.
Yeah.
For sure.
And it's such a good, and this is part of kind of going back to one of our other podcasts, why we believe in separating those who are doing your tax return versus those who are doing your financial statement preparation is we check each other, right? So it's good when the tax team comes on board and they're like, wait, I'm rolling. I'm about to use accounting terms, but I am looking at how your balance sheet is flowing, because it should flow from one year to the next, from one period to the next, and your equity section should be flowing that way. And it wasn't the flow wasn't flowing. And so they're the main ones who'll say, wait, I looked at the prior year tax return, it's not flowing. Because on our day-to-day preparation, we're not looking at prior year and doing, we're assuming in the system it's already flowed.
Right.
But it's usually through the tax process where we find out that there may be some corrections that we need to make. So that's good to have that second layer of defense to make sure that your financial statements are as accurate as possible.
Right.
Yeah.
And when we talk about going into the bank and having CPA or folks like us at your YBP representing you, is it shows up differently for the banker. So let's talk about that. Let's talk about the banker relationship. What's important about that banker relationship to you all?
Well, first of all, you have to have one.
Yes.
If you're a business and you're making money and you're making good money, don't just go with just open up an account and you don't get to talk to anybody.
Yep.
There should be someone at that bank that you have a
credit union.
relationship or credit union or that you have a relationship with, because you're putting a bunch of money in with them and they're earning money on your money, and there should be a relationship. So I think it's important that you have a relationship first and foremost, and that your relationship manager understands your business.
Yep. And don't be, if you aren't getting it, move. There is no reason that you need to stay in a banking relationship where you're not being serviced.
Yeah.
And if you're like, look, well, I only have a couple thousand, it's okay. If you're starting off there, you earned that. That's you've started your business account. You've earned it. You're working your plan. Be proud of that. You don't have to feel intimidated. you get support from folks like us who back you up and come in there with you, so you don't have to feel like I think sometimes people feel uncomfortable because that money's not their thing. This world is different to them. We're there to support you and to give that certain gravitas to, representing your business.
We
for
are
you.
the translators.
The translators. Exactly. Thank you, Kimberly.
And
so-
sometimes when your business contact leaves, whoever you've been working with, sometimes you might have to leave, especially if they're climbing the corporate ladder, from organization to organization or within the same banking system. It's good to keep those relationships active at all times. So
Yeah.
you can't if you ever need financing and can qualify at a traditional bank level, you've got to have a banking relationship.
Yes, definitely.
Yes, you do.
Yeah, I don't know many people who can go into a bank and get a loan, even with great financial statements, without having a relationship.
That's right.
Because that person has to basically support you
That's
when
right.
it goes to
And represent you.
underwriting and all these questions are coming back. They're like, oh no, they're good. I know this person. I've seen their financials
Right.
and all that kind of good stuff. So it's very important.
Yes.
All right. So to wrap it up, it is important to have good financial statements. We talked about balance sheet, retained earnings. Use those capital dollars to grow your business, not to run your business. Make sure you have a great banking relationship, and make sure that you have a CPA that is working with you on your financial statement preparation so that you are prepared to and can tell you, hey, it's the right time, or that is working with you on building out your plan. Did I catch everything?
And do it before you need it.
Yes, that's what I
And
was
do it
going to
before
say.
you need it.
Because that's her main point. You can
When
you
you
can
need
get
it, you won't get it.
Right.
I promise you won't get it. But, when you don't need it, that's when you get it. And I'd just like to quickly add, when you are fortunate enough to go the traditional route and get financing or a line of credit, especially in a line of credit situation, you need to use it. Now, you may not use all of it, but they monitor how often you use it. They will take it away if you don't use it.
Yep.
So if you need to buy a couple of computers or, something simple, it doesn't even have to be a whole lot, but use it.
Yep.
Pay it off timely.
Yep.
Key.
Yep. Because I have seen you can start with a smaller loan. You pay that one down, pay that off. You go back to them, they give you a bigger one.
Right.
And you slowly, and you grow because you've now had that relationship.
Yep.
All right. So now we're going to do our shooting the topic.
all right.
Well, first we got to shout out our shirts. So
Yes.
we're all
Yes.
matchy-matchy. They're in
Matchy-matchy.
black. I'm in the white. Black. Oh, white. No, Michael. So we've got, what are our shirts, ladies?
They are HBCU tennis.
HBCU tennis. And we got those at
The U.S. Open.
the U.S. Open. So the U.S. Open in New York, I guess how many years they've been doing it?
The HBCU?
Yeah, kind of.
Mm.
About
Uh,
3
I think
or 4 years?
I think it's post pandemic.
Yeah,
I think so.
Yeah,
But
post-COVID.
well,
Don't give me the line. I
Yeah,
don't
yeah,
know.
yeah. Although,
But we're happy they are.
yes, yes. Although they did do the Althea statue pre.
That was pre.
It was 2019 maybe? 2018, 2019.
Yeah, somewhere.
Yeah, don't get us to line.
Yeah.
But we talked about before how we're huge sports fans.
Yes.
And tennis is one of the things that we do together.
Yes.
Yes. And yeah. So we've had breakfast at Wimbledon at Keena's house.
Yes. With strawberries and cream.
And croissants.
For croissants for French Open.
Yes,
Yes,
the French
yes.
Open. So we do share our love for tennis, and being HBCU grads,
Yeah.
we
Yes.
we like to support their HBCU line.
Right.
Yeah.
So
We're
we
matchy-matchy.
all have that. And then there's also a local jeweler that is at the U.S. Open, and we also went to the Miami Open, a couple of, and they make jewelry that are like look like tennis things.
And I forgot to bring
So we've
my-
got some of that on too.
Yeah,
So
I didn't. Yeah.
to that local jeweler. I have to look it up.
Yes.
Share
Okay.
it. But they have very cute things.
Okay.
Okay.
So what we shooting?
And so our shooting topic is, since we're talking about capital, we're talking about credit. Let's talk about our biggest credit mistakes, because we are not perfect. We have lived a lot of years, and we've done some things great, and we've learned from things we did wrong. It's all about learning, though.
Yes, yes, yes.
And not repeating the same mistakes. So, what are some credit mistakes that you all made?
Where should I start?
Right. I was gonna say, 'cause I got a lot.
It started in college
Yes.
when, okay, first of all, let me just say, I worked for Sears Credit. Sears Credit, I guess was the name of it.
Okay.
Sears.
Yes, in the
Sears.
authorizations department.
Oh, okay.
So people would have to.
Sears was a department store.
Yeah,
yeah,
you
yeah,
didn't know.
youngsters out there.
Yeah, yes.
So with Sears, people would go in and try to apply for credit. So it was the perfect job. I mean, I loved it, and I learned a lot about credit. I got to see people's credit reports, and so I could see what their report looked like when they were automatically approved, and what their report looked like when they were calling me up saying, well, can we please, is there anything, and I really need this washer and dryer. So in college, I said, oh, well, credit is your friend. So I had like 11, 12 credit cards, all with balances.
In college,
and buying folks washers and dryers. And it was fine until
until
the washer and dryer bought. They didn't pay me the money.
Right.
Now, it was only $27, but I was a college student. I had $27.
$27 a month.
Wait,
Yeah.
$27 a month.
Yeah, yeah.
Okay, because I was like, what washer and dryer did you get for
paying it off.
$27?
Yeah, they were paying
Paying the
it.
balance.
I
They
was
were
hooking
making it.
everybody up with credit.
Glad Sears isn't around
Right.
anymore.
So, basically, I have overextended on credit in the past, and that is probably, I can't even pinpoint a lot of the purchases I made. As a matter of fact, Kimberly was giving me counseling one time, because I was like, Kimberly, I had $30,000 in credit, and I don't know what the hell I bought.
Oh, Lord. Oh,
So
that's a lot.
Kimberly, she gave me the
Yeah,
spreadsheet.
spreadsheet.
I had the
Kimberly got the
spreadsheet on.
spreadsheet.
When y'all was watching The Wire, I couldn't watch, because guess what? I couldn't afford cable. I cut out everything. I used my bonuses. I paid everything off. So that was probably one of my teachable moments of like, what the hell? And I would imagine now it's probably worse than then, because you swipe for everything.
Yeah.
Right. We didn't swipe for
back
everything.
then,
Right, we used cash.
paid a lot
Yeah.
of cash. So I was swiping when I shouldn't have been.
Right,
But,
right.
now everything is a swipe.
Yes.
So, and they've got businesses that will do it like a layaway.
Yeah. Afterpay.
yeah, that's
Their
right.
layaway
Yeah.
was afterpay.
They have
now.
Yes.
Afterpay. That's one of them.
Layaway done
That's one
turned
of
into
them.
afterpay.
Yeah.
Yeah,
you had to at least go to the store
Yeah.
and put down your $10
Yeah.
a week.
Right.
Yeah,
Yeah.
Now
every
you
time
just-
I buy something, do you want to pay all of it, or do
Yeah.
you want to pay?
Right.
You're right. $5 of it
Yeah,
right now.
Right.
Yes.
yeah, that's
Yes.
crazy.
Yeah,
So,
that is. So you're right.
So for me, it was in college. And this is how I came to the spreadsheets and all that. But it first started on the college campus. Fill out this credit card application, and we'll give you a 2-liter of Pepsi or a 2-liter of Coke. I never
And
liked
a squeeze bottle.
in a squeeze bottle
it's good as
or
squeeze
whatever. I was like, okay, because I'm a broke college student, and I want something to put in my refrigerator. Fill out a credit card, get the credit card. Then it's Friday night, let's order some pizza. It was little small
Little
things.
things.
Little
Death by a
things.
1,000 cuts.
Right, that built up. Talked about my pivot, my student loans that I accumulated before I transferred to North Carolina A&T. So at a certain point when I graduated from college, I'm making decent money, but I can't afford to live because I have student loan payments, have credit card payments, all of this. And so I think the last stupid mistake I made was leasing a car. I leased my red Acura Integra.
Oh, yeah.
I
you were
love that
fly,
car.
too.
I love
Yes.
that car. It was my dream car. But when the light bulb came on, I got the realization that's when I started building the spreadsheets to pay my stuff down. Paid off. I still, I paid that car off. I didn't turn it in, paid it off. And from then on, it was like, okay, I got a clue.
Yep.
And, to keep my credit rating
Yep.
decent.
And that's
What about you,
Well, real quick.
Kina,
No. Credit. No, same thing. But it was the Super Saturday sale at Macy's. It was. So we used to have to wear suit. This is the KPMG days. We used to wear suits. Oh, I go to Super Saturday sale and get the whole outfit, like the suit, the shirt, the clothes, the shoes, the blue. Oh yeah, would hit up a Super Saturday sale. Started with in college where you get a couple, not too. I got a little bit of credit there. I had to get a Discover, maybe, but it was right after, because then you think, oh, I got a job, I can pay it. Next thing you know, you look around. And
Death by
that
1,000
$75 suit now is $300 in credit
because of the interest.
So the whole sale, what was the whole point?
Yeah.
So so that was what led to me moving in with April because I wanted to buy a townhome, but I refused. I refused to have debt, and so I moved in and stayed on that first floor and paid off all my debt.
And brought her OCD with her.
And I would just put their stuff on the steps. Just put their junk on the step and clean everything
And
up.
we stepped over it. And she trying to send us a message.
Is it not a message when I put your shoes and things on the steps that you need to take it up to your room? So, shout out to Denise as well, our other roommate.
Out.
So, but that's why. So I, suck it up. Yeah, I was living by myself. It was cool. Hey. But no, I went in with 2 roommates and bit the bullet, paid off the debt, and have never looked back since then.
So we all sacrificed.
Yes.
We all went through
It
a
is
period
a
of sacrifice, but I think
Yes.
the key to take away here is credit can be good if you know how to use it.
Yeah.
Yes.
And
It
if
is
you
your
don't have
friend.
the discipline to use credit and pay it off timely, don't mess with it.
Right.
Mess
Leave
with
it alone.
Know that so. All right, everyone. Well, this was cap instead of no cap. This is cap. So thank you. We hope you got something from our podcast, and we'll talk to you next time.